So who won round three? Any guesses? That ass you're pointing backwards, or so not you? You don't think? It was. When I was processing it, I was telling Josh earlier, I said, usually I get to about the third step of processing and I get a little minimal data, and usually I can kind of glance at that and have a pretty good idea who won. But this one I looked at and said, boy, I don't have a clue here. Because I know that the team that looks pretty good is going to get a bunch of deductions. So this one might be a little tougher to calculate. So, well, let's go through the round real quick. Sales, look at Digby. Digby really took off this round, okay? Garnering a ton of market share. Ferris followed, but then you look just above that sales number, and of course you see that emergency loan number. And in fact, we had three teams with pretty substantial emergency loans: Baldwin, Digby, and Erie. So three pretty good sized emergency loans. I found a couple things kind of interesting. I was kind of looking at Ferris and Andrews when I was processing this, and look at Ferris, sales of 172 million. Andrews only 127 million, so $45 million difference in sales. Huge difference, right? And yet, look at the profit. Ferris only 4 million, Andrews 10 million. Okay, and again, it's pretty easy to just take a glance and say, okay, well, look at the contribution margin here, 37% versus 26%. So not only did they pick up a little better than 10% there, almost 11, they also had substantially lower SG&A to sales, so more efficient and effective. So again, being big isn't always necessarily better. Digby 196 million in sales, so the biggest sales of all, and Andrews still had a higher profit. So, that's pretty impressive. There's what, 60, almost $70 million difference in sales. Okay, huge difference. So, and yet Andrews was able to produce a lot more, or not a lot more, but not compared to Digby, but a little bit more profit compared to Digby on substantially less sales. So it's not always sales. Sales are huge. Okay, sales are huge, but ultimately turning those sales into profits and that's really the job of a financial manager, right? What are the things you're going to do to try to turn those sales into profits, make the company as profitable as possible? So we have the stock market. Looks like Erie is on the road to buying back a decent amount of shares. That might have a positive effect eventually over here. Well, it is already having a positive effect on its earnings per share, right? I might ask a question about that in your assignment once again. Chester, Ferris might have sold a little bit. Digby, you guys did that the round before, right?
Yeah.
Okay, yeah, I was thinking that, yeah, because you did $4.5 million the round before. Looks like with that big emergency loan, maybe you should have done a little more this year, but we'll see. Emergency loans are expensive, but it would be interesting to put a pencil and see if an emergency loan is more expensive than selling stock. Selling stock, what's more expensive, debt or equity? Equity is always more expensive, or I should say what's cheaper. That's usually how I put it, debt or equity, and debt's always cheaper, I say. It would be, where you're paying that penalty and whatnot for an emergency loan. That might take a little sharper pencil to actually figure that one out, because that's a pretty substantial penalty. But debt's always cheaper than equity. Okay, at least I could say almost always cheaper than equity. Some pretty substantial. Again, in addition to having good sales, we see that Digby also invested a ton of money in plant improvements. Yeah, so if I'm their competitor, I'd want to see what that is. Every team invested in plant improvements. Andrews almost none. Ferris quite a bit. And other teams kind of somewhere in between there for the most part. So. Dividends, Andrews is the only team that paid a dividend. Cash from long-term debt. That's kind of interesting. Chester's the only team that borrowed some money long-term. And Chester was one of the few teams that actually, it was the only student team that actually had cash, wasn't it? I think so, yeah. Everybody else had a emergency loan, so Chester had a little bit of long-term debt, not that much, and they ended up with some positive cash, decent amount of positive cash. So maybe the other team should have. In fact, they retired long-term debt. Look at that, Baldwin and Erie both retired some long-term debt, and that ended up having emergency loans. So that's expensive, right? And now in this case, the expense would only be to the extent of the $5 million and the $2 million, really. But that's a really expensive mistake to make, is to, retire long-term debt with an emergency loan. Basically, is what you're doing, right? Okay. Retirement of short-term debt, of course, that's automatic. The $69.50 though was a portion of your long-term debt that comes due in the third round. Okay. So it was coming out anyways. And Chester's the only team that actually borrowed some current borrowing. So each of these teams that ended up with an emergency loan would have had way more than adequate capacity to borrow money to cover that. Okay. So either they had higher expectations than what happened, or something went wrong, bad forecasting, whatever the case may be. Cash counts, what was the accounts receivable changes up here? So, oh, look at that. Yeah, inventories. Look at that. Okay, Chester's the only team that generated some positive cash from inventory, so they actually sold down inventories. Every other team then, right, accumulated inventory, and in a pretty big way. That's a decent amount of inventory there, 33, 43, 51, 71, and 13, so $85 million in inventory. Net out that, and so we accumulated, what, 70-some million dollars in inventory overall, it looks like. And we'll see that when we get down to those production numbers, right? It'll show up down there. So, big numbers. Glance through some of these things. Oh, we're finally to the point where we're using some capacity. That's actually a really meaningful change from last round. You got these bottom three teams at least look like they're using almost full second shift. Just glancing at this particular one, and even the top three teams are using more than the first shift anyhow. So we're finally to the point where by third round here, we're actually using a decent amount of capacity. Here's our inventory, like we said. You can just kind of look down. No huge numbers in there in terms of a big number in any one particular segment. It just looks like a lot of inventory kind of scattered throughout the segments and throughout the teams. Okay, so what we probably would say is that as a class, maybe we were a little bit overly optimistic this particular round in terms of what was going to sell. Okay. As a class, everybody got a little bit optimistic, and that's what ended up creating an excess of inventory. So a decent amount that a team would want to take into consideration going into next round, of course. Still got growth going on next round. I hadn't looked at the segments too much. Yeah, nobody stocked out here really. Sid did down here. That's probably their low-end product or something that's sold in traditional, or their high-end product maybe that's coming down. Yeah, that's their high-end product that's coming down, sold out there. Pretty even there in terms of potential and whatnot. Same thing there. Looks like Erie has abandoned the high-end segments. Not unexpected, right? Baldwin and Chester not competing a lot in there, so they're competing a little bit more probably in the low-end traditional segments, allowing the other three teams then to really kind of dominate those. Although Baldwin's competing like crazy here in the performance segment, that's interesting. Erie had some potential there, but it looks like they're vacating that particular segment. Had some, did pretty well there. Okay. Actual versus potentials down there. It's getting, it's really tight here, obviously, but otherwise it's getting pretty spread out. Compared to the practice rounds, you guys are doing a lot better job of keeping these products relevant up here. Okay. Which again, that takes a pretty concerted effort from round to round to make sure that your product's staying up there, not getting too carried away. We see products that are obviously exiting those segments as well. HR, look at that, 107%, 106%, 107%, so some pretty good improvements there, helping to have good, did TQM start this round? Wow. Cool. So some decent investments there. Ferris and Andrews, not a lot. We see Baldwin, Chester, Digby, and Erie, and especially Erie. Wow. Okay. Any questions other than who won, right? We'll take a look, and then I'll start over and do the this week's assignment. Oh, let's see. Digby did the best in earnings per share, and they did the best amongst the student teams in ROE. Andrews had the best ROE otherwise. But Digby had an emergency loan, didn't they? Yeah. Every team did, but which team? Chester? Chester's down a little bit, though, when it comes to earnings per share and ROE. Contribution margin, Erie had the best contribution margin, followed by Digby, followed by Andrews. Stock price, Andrews had the best bump up there, but Digby followed them. Profits, again, Andrews and Digby was really close, right on their heels. Okay. Cash flow, Chester, that makes a lot of sense since they're the only ones that maybe didn't have a emergency loan. Strategy, no changes. So we got Digby, right close to Andrews. They did have some deductions. Kind of depends if Erie's right there close. But Erie had an emergency loan too, so bummer. And leverage, Erie had a deduction and Digby did not. And they both had deductions for working capital. So all kinds of deductions. Baldwin had deductions in all three, as did Erie. Chester's the only team that didn't have any deductions, but unfortunately it's not enough to make up for the lead that the other team had. So kind of a close one, kind of an odd one with all the deductions that we had in there. So I would guess that that's a little bit aggressive, probably what I've said. You got to, be aggressive or go big or go home kind of a thing. So I guess maybe you guys kind of decided to go big, but that did create, when everybody goes big at the same time, it can create some issues. So especially when it's in the production side of things. So questions about that? And yes, I'll get the assignment posted, but let me stop this.